Greetings and welcome to CCIM Institute's webinar in collaboration with the Urban Land Institute, Climate Risk and Real Estate Investment Decision Making, featuring 4 expert panelists that I would like to introduce. Billy Grayson is Executive Director for the Urban Land Institute Center for Sustainability and Economic Performance. Prior to the Urban Land Institute, Grayson served as founder and principal of Bent Branch Strategies, which aids in supporting sustainability program development and managing sustainability reporting. Billy Grayson has also served as Director of Corporate Sustainability at Liberty Property Trust, where he oversaw Liberty's sustainability strategy for over 700 buildings in 14 markets. Our next presenter will be Laura Kraft, who is Senior Vice President of Global ESG Strategy at Heitman, a real estate investment manager with $44 billion under management. Laura establishes systemic approaches to embed ESG into investment decision-making and management of investments. Recently, Laura led the Heitman partnership with Urban Land Institute to publish the report, Climate Risk and Real Estate Investment Decision-Making, which explores current methods for assessing and mitigating climate risk in real estate. Our third presenter is Lisa Dickson. She is the Associate Principal and Director of Resilience for the Americas at Arup. Lisa leads climate adaptation projects for the public and private sectors and has presented at the Pentagon and a congressional briefing on climate security and investments in resilient infrastructure. Lisa currently serves as a faculty member for an executive level course on urban resilience offered through MIT and is co-editing a book on climate change for design professionals. Our fourth presenter is John Rollins. He is a consulting actuary who heads the property and casualty practice in Milliman's Tampa office. John specializes in consulting engagements related to catastrophe exposed property and flood insurance. John has served as Chief Risk Officer of 3 coastal property insurers. John has testified in the U.S. House Financial Services Committee and several state legislatures and produced many papers and media interviews on the subjects of property and flood insurance rates, catastrophe models, and reinsurance. And just a few housekeeping issues before our presenters get started. During today's webinar, you will have the opportunity to ask questions by using the Q&A feature on the toolbar at the bottom of your screen. To ensure enough time is allotted to cover today's content, the panelists will respond to questions at the end of the presentation. Additionally, if you are experiencing any technical difficulties, please use the chat feature. This webinar is being recorded, and a recording of today's presentation will be made available to attendees within the next 24 to 48 hours. Billy, Laura, Lisa, and John, please continue with today's presentation, and thank you so much.
Well, thank you, and thank you for the opportunity to join everybody at CCIM today. My name is Billy Grayson. As mentioned, I'm the Executive Director for the Urban Land Institute Center for Sustainability and Economic Performance. For those who might not be that familiar with the Urban Land Institute, we're an organization of 48,000 members from across the real estate value chain. Our Center for Sustainability works to build the business case for sustainability to help people across the real estate value chain make investments in sustainability that reduces their environmental impact and increases value for real estate. Next slide. So to kick things off, I wanted to answer the question of what climate risk and resilience actually is, and I'm going to try and do my best Al Gore impersonation for the next 30 seconds. Next slide. So, climate change, greenhouse gas emissions are going up. Next slide. That is leading to an increase in overall global temperatures. Next slide. And this is contributing to an increase in the frequency and severity of extreme weather events. They're not created by climate change, but because of the impacts of climate change, they're getting worse and they're coming more often. Next slide. So how does this relate to real estate? These climate-related events are also leading to a significant increase in the amount of unrecovered losses associated with extreme weather events. You can see in this chart from NOAA that we've seen almost a 3-fold increase in the economic impact of extreme weather events over just the last 30 years. Now, this is happening for a couple of reasons. One is because there are more extreme weather events and they are coming more frequently. But the other is that we are concentrating more of our high-value real estate in areas that are vulnerable to climate change, partly because we love to live, work, and play on the coasts and in river deltas. Next slide. Now, what we're seeing associated with this is that markets are starting to respond, and they're starting to look at both climate mitigation and climate adaptation as a core strategy for how governments and the private sector are going to deal with the long-term threats of climate change. So we see the Paris Climate Agreement with an agreement to move to a 50% reduction in greenhouse gas emissions by 2030 and a move to reduce by 80% by 2050. We see the U.S. pulling out of the Paris Agreement, but over 300 mayors reaffirming their city's commitment to the Paris Climate Agreement to address the long-term threat of climate change. And as these global political forces are moving to address climate change, we're also seeing private sector actors and movers helping to drive us towards addressing climate risk in every sector of our economy, but especially in the real estate portfolios. So the International Insurance Society has set underwriting guidelines to start addressing climate risk in how you write and price insurance policies. Moody's and other financial advisors are starting to send signals to private and public actors that if they don't integrate climate risk into their strategy, they may face a downgrade in their credit rating. Global organizations that are rating organizations' commitments to sustainability, like the Global Real Estate Sustainability Benchmark, are working climate risk and resilience into how they score the sustainability strategy of real estate portfolios. We have global reporting frameworks increasingly looking at resilience as part of how they are asking companies to report on their sustainability strategy, including the Task Force on Climate-Related Financial Disclosures. And we're seeing I don't want to call it an explosion, but a tremendous increase in the amount of sustainability-related debt and equity investments that are available in the marketplace. One indicator of this is climate bonds, which have gone from a $4 to $5 billion market about 5 years ago to over $300 billion in investment last year. Next slide. And we're seeing the biggest capital players on the planet starting to talk about ESG and working resilience into how they talk about what it means to be a sustainable company. So BlackRock and Goldman Sachs have recently issued some very significant warnings about companies that are not integrating climate risk into their investment strategy. We're seeing insurers, leading insurers like AXA, Swiss Re, and Munich Re starting to give guidelines to their portfolios that climate risk needs to be part of their portfolio level strategy. And we're seeing leaders in real estate asset management and REITs like LaSalle, Boston Properties, Alexandria, and Heitman make resilience a core part of their ESG strategy. Next slide. And we had the opportunity last year to work with Heitman to survey 30 global investors who are investing in real estate to ask them the question of how they are starting to look at climate risk in their investment portfolios and how they think that climate risk might affect how they evaluate their real estate investment decisions going forward. We heard from these folks that this is a lot harder than your traditional pro forma, that the uncertainties around the time frame and the magnitude and the location of climate physical risk makes it really tough to price this into a real estate investment decision. They also shared that while the physical risks are daunting, the ecosystem of risks that are created, financial risks, makes this even more complicated, that even if a major physical risk does not manifest itself, there's a chance that insurance may be repriced every year. There's a chance that a city may change its tax structure to address resilience issues, or a number of other financial shocks that may manifest themselves before a physical risk even impacts their portfolio. Given the long-term threat of climate change, it's also tough when most real estate investors' investment horizon is 3 to 6 or 3 to 8 years to integrate some of these long-term risks into the short-term portfolio decisions that they're making. And it's a complicated issue from a disclosure standpoint. On one hand, you want to assess and start mitigating the physical risks in your portfolio, But as you're doing that, is there a duty to disclose this information? And when in your resilience process is it time to disclose what you've found from your assessment of physical risks or how you're plotting your mitigation strategy? Next slide. I also want to point out that people are measuring your risk, whether you're doing it or not, when it comes to real estate investment on climate risk. This is an example of analysis done by 427, who's part of a growing cottage industry of physical risk modeling data providers who are working with real estate investors and real estate companies to start assessing and quantifying the risks in their portfolio. This is a graph of the physical risks associated with different REITs in the portfolio, as well as the magnitude of those risks. Next slide. So what does good practice look like when you're starting to tackle climate risk? The first one is what geographic locations are going to present the highest risk. Then thinking about how this risk is something that is physical but also is transitional, and how do you integrate the physical risks along with those transitional risks into an investment assessment. And finally, thinking about what else you can do to mitigate your risk once you've understood it. So how much is it going to cost to retrofit my assets? What is the likelihood that my city will make investments that reduce all of our risk? And what is the chance that insurance prices and availability will change during my hold cycle? Next slide. The takeaway from our study, and something that all the investors asked us to pass on to anybody that we talk to about climate risk, is that it's important for people not to overreact, but it's also important not to underreact. Climate risk and resilience shouldn't cause real estate investors to leave the coast immediately, to make non-cost-effective investments in hardening assets, or global investors to stop investing in real estate. At the same time, it's really important for everybody who's involved in a real estate investment cycle to start assessing this risk, to start better understanding the physical and transitional risks, and to talk with all the stakeholders in their real estate value chain to get a better and more accurate assessment of both the risk and the cost to mitigate those risks. And there's a discussion about whether we can do this together as an industry or whether it's more important for everybody to start this investigation on their own and then start mitigating this in their asset portfolios. Next slide. And with that, I'd like to turn it over to Laura Kraft at Heitman to talk a little bit about how they are tackling these issues.
Great. Thanks, Billy. And so I'm Laura Kraft. I work for Heitman. We're a real estate investment management firm. Next slide. So this gives you a little bit of an overview of our firm. We have $44 billion under management across the globe, roughly 1,200 assets. And so when you think about real estate, it's bricks and mortar, it's hard assets, and it's not the most liquid of assets. So we're investing today with focusing on tomorrow. It's a longer term horizon. And over the course of the past 10, 15 years, we've been ever increasing our focus on ESG, because we do believe that ESG can influence our returns positively by identifying those opportunities and then also identifying risks that we could potentially mitigate so that we don't lose value in other assets. Next. And if you think about where cities first were located, they were located on coast, near waters, near the ports. And so as you think about these cities, these gateway cities are especially exposed to climate risk. Next. Last year, we did a study looking at all the property within the NCREIF Property Index, and we mapped it against sea level rise storm surge. So what you're looking at is a number of dots across the United States, and the color of the dot indicates the risk to sea level storm surge, and the size of the dot indicates the value in those particular locations. So actually, New York has more value, institutional real estate value at risk to sea level storm surge than Miami. Next slide. The conversation 10, 15 years ago was about how sustainable is your building. When I think about sustainability, it's about the operations. Are you managing energy, carbon, water, and waste at your asset? And recently, it's turned into resiliency. You can improve the operations of your property, but you can't pick up and move a property to a different location. So we have to think about the resiliency of locations. Next. And as Billy mentioned, there was a report last year that Heitman partnered with ULI to look at the market. We wanted to understand, where is the industry at? Is climate risk being priced back into deals? What are the best practices that institutional players are implementing when they're looking at their portfolios and when they're looking at acquiring assets? Next slide. And if you want to sum up that report and take away one thing, it's this chart. This chart is in the beginning of the report, and it identifies the risk, the potential risk to real estate, both the physical risk and the transition risk. So the physical risks are more short-term risks, things that could happen to your property, whether catastrophic events and weather pattern changes. The transition is, what is the risk to a property over the hold period? What's the market going to do over that 5, 10, 20-year horizon? What about policy and regulation that could be implemented that would require you to report against the building? And then thinking about the market position upon exit. Next slide. The question is asked, well, I have insurance. Aren't I covered against climate risk? And if you peel back the layers, we're investment managers investing in assets for 5 to 10 years and selling to other institutional investors for another 5 to 10 years. Our investment horizon is 5 to 20 years. Insurance is a 1-year horizon. Insurance gets repriced every year. So they're thinking about the climate risk to a particular property over a 1-year horizon. So essentially, you can be covered on a 1-year basis going forward, but in 5, 6 years from now, how much does it cost to get that level of insurance? And what insurance doesn't protect you against is investor sentiment on viewing how valuable your property is. So in 5, 10 years, when you go to sell an asset, an investor could view your property as more risky because of the climate-related risk to the property and maybe devalue your property. Insurance isn't going to cover you against that. Next. Again, is there risk to property values? This is an interesting study looking at NACRE's property as well and pairing it against the National Hurricane Center study. And what it did was it found that all properties that were impacted by a hurricane, whether there was damage or not, that values were down 6% 1 year after a storm and 10.5% 2 years after. What's not said on this slide is that the property types were impacted differently. Apartments 1 year out were still down, but were down the least amount, most likely due to people being displaced from their homes and needing short-term stay. What was down the most 1 year out was office properties. Office properties, the leases aren't trading as much, but investor sentiment, the cap rates must have been higher, that investors were viewing these locations as riskier. And then 2 years out, the office properties weren't down as much, but were still down. Next slide. So to put all of these risks on the timeline, going from shortest to long-term, you could have a property that has physical damage, and you can repair it and do all the things necessary to get the building back up to how it was before damage. But what's going to come is these ripple effects that could occur, is that your insurance may go up the year after. A few years later, the area surrounding the property, if the city needs to fund infrastructure to help protect and mitigate risk from occurring, a normal funder of that is property taxes. So you see your property and taxes increase. Investor liquidity could be reduced if an area is now more costly, you have more insurance, and an area is deemed riskier, you could see reduced liquidity. And in a more extreme cases, you could see economic and demographic damage. In the case of New Orleans is still not up to the pre-population, pre-Katrina. So you think about that these events could impact particular areas. And you're seeing it also in Miami, where certain areas, low-lying areas, are trading at discounts, those exposed to flooding and the sea level rise, and that you're seeing a gravitation towards higher elevation areas. Next. So here's a little about what Heitman's doing. We're screening and scoring our portfolio against floods, sea level rise, water stress, heat stress, earthquakes, wildfires. We want to understand what is our exposure, because what you measure, then you can start to manage and you can start to understand how you can protect yourself against risk or mitigate the risk. Next slide. Another thing we're doing is during an underwriting of an asset. So we're first identifying what is a property's exposure to a particular risk, and then we're doing further due diligence. Has the property mitigated against the risk? What about the surrounding area, the infrastructure? How is it protected against potential risk? And then in extreme cases, we're thinking about that residual value. Is there going to be lower demand for the property when we go to sell the property in 10, 20 years? Next slide. So from an overall point of view, it's climate risk is essentially can be investment risk. So climate risk can cause increased investment by landlord and potentially decreased demand from investors and tenants. And so this slide outlines those physical risks, the transition risk, how it could impact your NOI, your cash flows. And if you're decreasing your NOI, then the property is going to be valued at a lower value. So you could see reduced investor interest, reduced occupier demand. When events happen, it could mean more maintenance, more expenses and operating costs. Insurance costs are another thing to watch, as well as real estate taxes. All of those going in the wrong direction can impact your NOI and, again, your value. So taking an apartment, for instance, residents pay a flat monthly fee, rent, and everything else is the landlord's expense. So if you're impacting that in a negative way, then you're impacting the NOI and the value of that property. Next. And with that, I'm going to turn it over to Lisa.
Great, thanks so much, Laura. So I'm going to spend the next couple of minutes talking about climate change from a designer's perspective, and not only from a building-centric perspective, but also with a reminder that all of the built environment is underpinned by this complex ecosystem of supporting infrastructure. So by supporting infrastructure, I'm referring to things such as the transportation system, water, waste, energy, and telecom systems. And so as we start to think about resilience moving forward, it has to be beyond just the building scale, but really understanding the larger ecosystem and all the intricacies of that. But before jumping in there, next slide, please. I'd like to zoom out and actually frame this a little bit more widely from a geological perspective. What you're looking at here is a graphic showing the variability in temperature changes over the last 150,000 years. We actually have a chart that goes back 4.5 billion years, but seeing that I only have 10 minutes, we're just going to stick with the last interglacial for today. What this graphic is showing is that these are temperature fluctuations on a yearly basis over the last 150,000 years. And I want you to focus your attention on the right-hand portion of the graph that's labeled the Holocene. So this represents the last 10,000 years of history. And what I want you to notice is that there's a very tight band there with respect to temperature fluctuations. In fact, there's very little variation. And it's during this same time, these past 10,000 years, that civilizations have flourished, that we're able to build very complex permanent settlements to stay in one place and develop a geographic footprint. And again, that complex infrastructure that underpins all of that. But all of that is about to change. And the second point I want to make is that we often hear that change is the new normal. And actually, change has been the status quo. It's been the stasis that's the new normal. And we're about to translate out of that and into a period of change. So what does that mean in terms of some of the inputs we have to consider for design? Next slide. So as we've heard earlier, there are some mega trends. This is focusing mostly on North America, but this is the same globally. In general, when we start to think about precipitation, we're going to see wet places get wetter and dry places get drier. but not evenly throughout the year. So for example, if you were to look at some of these areas and just focus on the annual yearly precipitation amount, oftentimes what we're seeing is that those are staying pretty much the same. But what we are seeing is that we have more intense storms, and that we're dropping more precipitation during these very small periods of times that are then being punctuated by longer periods of no precipitation, so longer periods of drought with heavier downpours. So that really has implications from a design perspective. Next slide. We're also anticipating to see continual increase in temperatures. And just to kind of give you an example of how that translates to a city scale, some of the work that came out of Boston looked at the number of degrees above 90 that we would hit during the summer, what that currently is, using 2016 as a baseline, what that's anticipated to be in the 2030s. And I should say, when we use these climate projections, that's actually 15 years on either side. So when we say 2030s, it's actually 2015 to 2045, meaning that 2030 is something that can be happening now. And in the case of Boston, we're already seeing at least 30 days with temperatures above 90 degrees. And then by 2070, we could have an entire heat wave for the whole summer in Boston. So again, what does this mean in terms of how we design the buildings for use and occupancy? Next slide. And at the same time, we think about extreme temperatures in terms of the increase, and it seems somewhat counterintuitive to think that we'll actually have extreme cold because of climate change. But from a scientific perspective, it actually makes quite a bit of sense. In the recent past, we've had a very strong thermal gradient, which allows for the development of this strong jet stream, which basically kept all the cold air in northern Canada and above. With a degradation of that thermal gradient, what we're seeing is a sort of much more wobbly jet stream, which allows that cold air to move south. And so from a designer's perspective, we are forced with extreme heat waves during the summer, and at the same time starting to have to design for extreme cold snaps in the winter. So having to think about a delta of at least 100 degrees in some of these places in terms of our overall design and operations. Next slide. So previous presenters have done a great job in terms of outlining the fact that climate change is costly. It costs a lot of money. And this is just a quick snapshot from the US alone in 2017 that had more than $300 billion of losses associated with extreme weather events. And that is likely a very low estimate because it doesn't take into account a lot of the other cumulative and indirect economic impacts. The next snippet to the right is some work that came out of ASCE that shows where we stand with current infrastructure funding. And even without climate change in place, we are already have something like a $4 trillion gap in terms of needed infrastructure funding. So that's without all this additional impact associated with climate. And then on the right is some work that recently came out of IPCC that said by as early as 2040, we could see something like $54 trillion annually in damages associated with climate. And just to put that in perspective, the global GDP for this year is somewhere around $89 trillion. So the point of this slide is that it absolutely makes no sense for us to continue to design the way that we have, even without climate change. And climate really gives us that extra push to think about things differently. Next slide, please. And so people are starting to respond to some of these climate impacts. Laura just mentioned the fact that in New Orleans, we know that there hasn't been a full recovery. We know that there are people there that will never return. And as a matter of fact, people are starting to look at this and project what climate migration might look like within the United States based on sea level rise alone. And so this is a very interesting graphic as you start to think about where people are going to be moving, where the in-migration, out-migration states might be, both in terms of residency as well as tracking the workforce. Next slide. And in some ways, this is sort of the reverse of that, basically saying that there will be winners and losers with respect to climate change. This was an interesting study that looked at a bunch of different aspects of economic damage associated with climate change. Green means that you actually have a bit of an opportunity. Red means you're probably not doing so well. Another way to interpret this map, thinking about migration, all those green areas are likely places that people are going to be migrating to. The orange and red areas are likely places that people are going to be migrating from. So what does that mean in terms of real estate? Next slide. Okay, so this is the puppy slide that I've just found during all my talks. I need to put some sort of a lift in there because it's kind of depressing for the first few minutes. So just to have a little bit of reset, everybody loves puppies, everything's going to be good. So the good news about all of this is we kind of know what's coming down the pike, that we can start to think about what do we do about it in really concrete ways. So next slide, please. From a designer's perspective, this is where we start to translate those climate risks into actual modifications to the built environment. And we do that in several ways. This is just an example of some of the work that we've done around sea level rise and storm surge. Well, the key thing to notice here is there are a bunch of different lines that you can design to in terms of those different gradients coming forward. Many of these, such as FEMA, is actually sort of the regulated line. That's what's in code. You would be in keeping with code to design for that. However, as you can see, compared to the other lines, you're probably really going to be underestimating, especially if you have that longer term view of the property, of what that means in terms of your overall flood resilience. So a lot of our work is actually to take these latest scientific findings, to plot those in such a way, and to have conversations with our clients about the overall risk tolerance, the overall expectations for performance of these buildings, and then optimizing those needs with a cost-effective solution. Sometimes it's built, sometimes they're operational considerations, and sometimes it's actually having a larger due diligence conversation about whether or not this is a good place to invest in. Next slide. And as I mentioned, it's really important not to have such a building-centric view, that we really have to recognize that we're dependent on this larger ecosystem of services. This is just some work that's coming out of the Boston area, again, working with Partners Healthcare, a large hospital organization. Even if they were able to do everything to the buildings design in place, this is the amount of flooding that we might see during one of those major storm events in 2070. As you can see, you can't necessarily get to the facility. Likewise, they might have neighboring facilities that are flooded out that they might have to take those patients from, and then the overall how you can get employees back and forth becomes a larger issue. So transportation systems are one of the most vulnerable and exposed assets, and probably the most difficult to serve in terms of climate, but it's something that all real estate is dependent on. And on the right, telecom is another example of that that's often forgotten. As it currently is, we are undercapacitated in terms of what we need for the digital age, let alone what the implications could mean with respect to climate impacts. Next slide. So another part of the work that we often do is really trying to quantify what the return on investment is for preparing for extreme weather. And as Laura brought up, the time horizons are really important, needing to look over longer than year by year, where those risks get reset every year, but cumulatively, what's the overall risk and what's the return on investment for making modifications upfront within those buildings or rehabilitations. And we found all the times that we looked at this, there was always a positive return on investment with respect to climate proofing. And last slide, please. And so I want to end with a slide because oftentimes folks think that resilience is really expensive. That's something that's just going to go outside the overall building costs. It's something that it just can't be considered. But resilience is a lot like sustainability in the early days. Sustainability is something that really isn't expensive if you consider it up front. The same with resilience. And I'm just going to use this as a quick example. Following Katrina, Partners Healthcare in Boston was building a new rehabilitation center. A lot of terrible lessons learned there that they did not want to repeat. You can read on the right of all the different upgrades that they made. And all of this work that they did, which by the way is a poster child internationally for a resilient structure that happens to be located on the coast with a very vulnerable population. All of those upgrades cost less than 0.5% of a premium on the overall construction costs. So again, resilience isn't necessarily costly. It just demands very proactive upfront consideration during the design or rehabilitation or even operational plans. So with that, I think I have one more slide just to remind you again of who I am, and then I'm going to hand it off to John. Thanks so much.
And thank you, Lisa. Now, you've heard from some of the prior presenters that property can't move, and therefore Adaptations need to be made to climate trends with an awareness of the long-term horizon. You've also heard that insurance is kind of an Achilles heel in the climate adaptation system because it's priced annually. You put those two things together and you get a process called climate gentrification, which is something relatively new to us and something we recently began to study in order to give ourselves some insight. And there's a twist here. I'm a consulting actuary with Milliman. Well, actuaries price insurance for a living. So historically, we have been part of the problem in the sense that we have been creating prices for contracts which were designed to operate over 1 year. But we'd like to look forward now and think about property insurance and flood insurance and how they might serve as economic and demographic incentives for migration out of a potentially climate impacted area or adaptation in place. So you could give me the next slide and I'll explain what we think climate gentrification is. To be honest, it was a term we hadn't heard before last year. And at Milliman, I work in our Tampa office. Many of my colleagues work in the San Francisco office. So we're constantly dealing with insurance pricing problems related to hurricanes, floods, and wildfires. And we picked up the paper in the Miami Herald last year and read about climate gentrification. And what does that mean? When we studied the issue, we decided to define it in kind of a quantitative way such that we could perform some research and satisfy our curiosity answering some questions. First of all, we defined it as the potential for migration of people, not property. Property can't move, but people can. And that means the impacts for the demographics and economics of any local region are going to be pretty significant even if the property stays in one place. That potential migration could occur from low-lying areas, and some of those areas are low-lying but very affluent socioeconomically. People with the means to move could move and choose to migrate to areas of higher elevation, but often we find in some regions that those are also areas of greater socioeconomic challenges where incomes are not as high. Homeowners in the US, it need not be said for this audience, make long-term commitments to own property, and sort of the 30-year fixed rate mortgage might be the most important economic innovation in history. It's probably not overstating it to say it's an incredible tool because it essentially gives the average person, the average citizen, a stake in the future economy. But these same homeowners are also increasingly aware of information. Information is also much more pervasive than it was just a few years ago due to technology and other factors. And these homeowners are becoming aware not only of the risk they face now to their property in the form of insurable hazards, but how climate might affect those things in the future. So we wrote a paper and it was designed to really answer some key questions aimed at the audience of community leaders and urban and resilience planners. And we endeavored to answer these questions. How might an increase in the physical climate risk, the category of risk that Laura talked about, the physical risk, affect the desirability of living in these communities, particularly within a metro area? Second of all, is there a role for insurance to play here? What incentives does insurance create now, and what incentives could it create if the actuaries and others in the industry adapted? And then third, and probably most importantly, the bottom line, how do we manage the socioeconomic impacts as people become aware of hazard, become aware of increasing hazard, and make millions of individual economic decisions? Next slide. First thing we're going to do is define the risk and give ourselves a mental framework to think about the problem at the regional level, which is conducive to collecting some data and then processing that data to say something hopefully interesting about it. Next slide. We chose South Florida, not only because it's a region I know well and a region that gets a lot of scrutiny, as evidenced by the Miami Herald article and the local newspapers talking about this issue, but it's one of many regions that we would describe as a climate crucible within the US. Now, what do we mean by that? First of all, it's a mostly urban area with a large population, so the stakes are high. Second, that area has a wide range of income levels. It's not homogeneous. It's not an enclave for the affluent. It's not an area with persistent poverty challenges throughout, but it's got a very wide range. And if you've ever been to South Florida, you know what I mean if you've driven up US 1. You go from very poor neighborhoods to very exclusive neighborhoods, and sometimes so fast it makes your head spin. It's an area with well-mapped local hazards. So in South Florida, a lot of attention has been paid to storm surge risk because of prior hurricanes, and also tropical systems that have dropped lots of rainfall and created what we call pluvial flooding. So there's a recognition that the hazards are local, and there's been a lot of science devoted to mapping them at a granular level. Finally, the kicker is that it has to be an area where there is a documented increase in hazard due to climate changes or climate trends. In this case, we're talking about sea level rise and the increase in precipitation from tropical storms and hurricanes. And in fact, South Florida has a group called the Regional Compact on Climate Change that has brought together a number of planners and scientists to actually quantify that. So we used the output of their sea level rise projection in this study. Bottom line, it's a problem, and we wrote a white paper about it, so we've provided a link there below if you're interested, and this talk is based on that paper. Next slide. So getting to the fun part, how do we want to think about this? We plotted household income on one axis and flood risk on another, more or less on the back of a napkin, and came up with this kind of quadrant approach. Then we set about gathering data and putting some specificity to the parameters we're talking about. Top left quadrant we'll call the stable quadrant, just as a keyword. These are relatively socioeconomically affluent areas, more specifically, areas where the census block groups that make up that area are not in the bottom 25% of household income for the region as a whole. And they're areas of relatively low flood risk, meaning, once again, and more specifically, they do not have the majority of land area in their census block groups inundated in a flood that has a 1% annual chance of occurring, not today, but in the year 2050, as defined by our collaborator, which is a climate science firm called Jupiter Intelligence. We worked with their science and their maps, which gave us, based on the RCP 8.5 scenario of the IPCC, some plausible inundation threats for 30 years down the road in the year 2050. That top right quadrant, let's describe that as the emigrating quadrant. They have relatively higher incomes, not in the bottom quartile like the stable areas, but those relatively affluent citizens will be inundated as sea level rise and increased tropical storm precipitation produces climate adjusted flood risk. Now let's turn to the bottom left, destination quadrant. What does that mean? These are these relatively high ground areas that do not show inundation in climate adjusted flood risk of 2050, but they're also areas with persistent poverty, with a lot of incomes in the bottom 25% as measured by census block group income versus that of the region. Finally, on the bottom right are also very interesting and challenging areas for urban planners, crisis areas. This is basically the group of census blocks that is double whammy. They have low household income and a high flood risk now and in the future climate. Next slide. In South Florida, the first thing we did is put a bunch of data together to analyze the risk profile and put it into all of those quadrants. Next slide. And this may be more of interest to the policy wonks or the science wonks than the developers and attorneys, but suffice it to say, we took Jupiter's maps processed for an inundation in the quote unquote 100-year or 1% annual chance of a flood. We used census data to overlay the block groups with high and low incomes. And we use proprietary data on the right, which is essentially a lot of data points about where people live and what type of home they live in that region. And that we call our Milliman market basket. We take about a 10% sample of what we think is the entire population of insurable homes in the area. When you mix all those ingredients, you get what is on the next slide, please. And that is a map showing the risk, and for every census block group in the area, what quadrant it would fall in. And we've used the same color codes to indicate stable, destination, emigrating, and crisis areas. What immediately catches the eye is that there's a collar of northern and western suburban neighborhoods in Broward County and Miami-Dade County that would be described in that stable quadrant. But you know, there's a lot of scattershot nature to this map. There are emigrating areas that are low-lying areas filled with people who may want to migrate out of those regions as the climate adjusts to future conditions. But they're kind of everywhere. They're on the beach, of course, affluent neighborhoods that are low-lying, you might expect that. But you also see that they really are scattered throughout the region. Same with the destination areas. These tend to be urban areas closer to city centers that lie on higher ground. But once again, they're not in a uniform place. They're scattered. And then finally, for planning purposes, you can see that the areas close to canals and other water sources tend to be the crisis areas. They're areas where people may not want to live in an inundated scenario, but they also are filled with people that have the fewest adaptation options in terms of income. Next slide. Now let's think about insurable value real quickly. Next slide. What we do as actuaries is often look at a property's hazard risk, just like on the map you saw, and then whether or not we adjust it for climate trends, we translate various factors about that property and the geography it sits on to the price of insurance. In particular, we wanted to know how much insurable value of these residential properties, and now we are sticking to residential properties in this analysis, is at risk. I realize some of you may not be able to read these slides in terms of the numbers, but suffice it to say that about 45% of the people and the property value are in the stable areas. But if you look at the emigrating areas, the destination areas, and the crisis areas, none of them is an academic exercise. Emigrating areas have about 25 to 30% of the value and the population. Destination areas about 13 to 15%, and crisis areas over 10%. So these are all significant blocks of the population and all deserving of critical thinking about how these subpopulations can and will adapt, either by moving out of the region altogether, migrating within the region, or adapting in place. Next slide. Finally, we put kind of a topper on this. We talked about insurance maybe being part of the problem as well as part of the solution. And I think most people in the real estate business would agree that that double-edged sword applies to the National Flood Insurance Program. Next slide. So under the current federal flood insurance options, which is called the National Flood Insurance Program, we actually took our rater, our rating machine that can take any property and figure out what we think FEMA would charge for flood insurance, and we applied that to all of these properties in every quadrant. What we were hoping to see is a clear incentive where flood insurance would cost a lot more per $1,000 of home value in the low-lying areas, and therefore encourage people to migrate out of the low-lying areas, in part because their flood insurance would be cheaper. Unfortunately, that's not what we found. So there's a little bit of inside baseball here regarding the total value of these homes, because the NFIP only provides insurance for the first $250,000 of a home's value. What you see is that when you consider an NFIP policy as a consumer at that limit of $250,000, then sure, the rate for an emigrating area seems to be higher than in a destination area, which in theory would provide an incentive to migrate from a low-lying area to a higher area. However, when you look at the total expenditure on that insurance compared to the actual value of the home, which might be a $500,000 home, might even be $1 million plus home, you see that there's actually an implicit subsidy in the NFIP rates for larger homes, because the emigrating population tends to have higher home values. And so when they sort of max out that NFIP policy, there are many people that, compared to the entire value of their home, are getting a phenomenal deal on flood insurance from the federal government. So that $2.43 charge versus the $3.02 charge in the destination area, to somebody whose concern is dollars they pay for flood insurance versus dollars of home value, flood insurance looks about 20% cheaper in the area they're in now than it would in the destination area. So there's a lot of work to be done to fix that, and we can talk about that on the last couple of slides. So next slide, please. So let's talk about that going forward. Next slide, please. The insurance market, like other markets, and as Billy said, is slowly adapting to these trends. First of all, there's an expansion of private flood insurance as an alternative to the NFIP. Now, this isn't a webinar about private flood insurance, so I won't go into detail, but many states, led in fact by Florida, are trying to allow alternatives to a federal program. Federal flood insurance, importantly, will also be changing. The entire approach to pricing, which resulted in some of these distortions and perhaps perverse incentives you saw on the last slides, will change. It doesn't mean those incentives will entirely go away, but the federal government is currently undertaking the biggest revision to its rating plan that's ever been undertaken in the last 50 years since federal flood insurance started. Now, there's been a very recent announcement this week that there's a slight delay in the rollout, and it'll be rolled out in 2021 rather than 2020, as you might expect from a program that has political masters and is concerned about potential rate increases for some populations during a very intense political season. That said, they will be rolling out new and much improved rates in the near future, and that could help restore those incentives. Next slide. And finally, to wrap up, I'm sorry, could you go back one? Thank you. Finally, to wrap up, insurance technology is actually coming to the palm of the consumer's hand. So we talked about the consumer getting more aware, getting sort of awoken to climate trends. This is actually happening at the smartphone level, meaning insurtechs are quoting policies right in the palm of your hand now. They're targeting individuals by saying, here's where you are, here is some risk data about where you are, both now and adjusted for climate. Jupiter and others are doing this. And they're saying, do you want an insurance quote now? Do you want to know how this property might be insurable or non-insurable in the future? So the bottom line, I think, is that we as leaders, whether public or private sector, have to adapt to this world where the consumers know more than ever about both their current hazards and their future hazards, and in some cases, frankly, may know more than we do. With that, I'll throw it back to Liz to wrap up and take questions, and I really appreciate your attention.
Thank you so much to all our presenters. So much fantastic content. And I do have a two-part question that I'd like to ask our panelists to wrap things up. The first part of the question is there any framework to include climate risks in debt underwriting and asset valuation?
This is Laura. I can attempt to answer this one. So in terms of frameworks to include climate risk and underwriting and asset valuation, I'd say 10 years ago, if you were to ask a real estate investor, do I need to underwrite this? They were looking mainly at insurance and saying, well, I have insurance and I'm covered. And the insurance over the past 10 to 15 years has been able to cover that. But as you look forward and we become more sophisticated in how we're looking at these risks and as insurance is becoming more sophisticated in pricing the risk, that's where it's become institutional managers, investment managers' responsibility to underwrite this. So there isn't necessarily a framework for how to do so, but I do think that you need to understand what tools are you using to underwrite. So meaning, are you using FEMA maps, or are you using something more sophisticated like Jupiter and 427 that's getting to the specific site, identifying the risks at hand? So in terms of advice, I would say make sure that you have a good tool to identify a property that you're looking at and what the property may be exposed to, and then do on-site due diligence. If the property has high exposure to hurricanes, make sure that the property has hurricane straps, that is risen above a sea level rise, or risen above sea level rise, so the elevation of the property. Doing on-site due diligence and getting some engineers to not only look at the property, but the infrastructure around it, the roads, the power, the telecommunications. So that's hopefully answers that question, that there isn't necessarily a framework that we're all growing. If you want, I'll give another plug to the ULI Heitmann Report as a good place to go to see what others in the industry are doing and in terms of how they're underwriting climate risk into the investment decision.
This is Billy. One other really quick thing I'd add to Laura's
add to Laura's comments is that, Moody's, S&P, and Fitch have all said that they're starting to assess climate risk and that eventually it'll affect credit ratings and bond ratings. So I think anybody who's interested in a framework should keep asking those folks about how they're going to be determining that, because eventually it will be built into certain credit ratings and bond ratings for both private and public sector. So hopefully we'll see something coming out soon.
Just thank you so much, Billy and Laura. And to follow up on that question, the second part was asking, is there any due diligence checklist for investment assessment before buying or lending over an asset?
I think it goes back to the first question of understanding what the property may be exposed to, and then doing on-site due diligence. A lot of this, none of this is necessarily new. If you are hiring a third-party consultant to do physical condition assessment reports, sitting down with those consultants, those engineers, and saying this property is exposed to this risk. Let's say heat stress, water stress, flood. How is the property at risk to these factors? And I think working with the consultants, with the engineers, with on-site due diligence, they should be able to write up a summary of what the property's risk is.
And this is Lisa. Just to add to that too, I agree with what Laura is saying, but there's also the Task Force for Climate-Related Financial Disclosure that came out about 2 years ago now, that I think provides a pretty good framework about how do you start to translate those risks into sort of financial indicators, and if just as a good place to start to understand the basic framework and how we might start doing that, that would be another resource to look at. But I agree with Laura. Right now, it's sort of in its infancy, and there isn't necessarily a go-to standardized checklist. But one of the items that is supposed to be coming out of that work from the task force is more sector-specific list about what really does and doesn't matter with respect to climate risk from sort of a fiduciary and financial perspective.
I would add one quick point. As you're assembling data on a property, it's probably goes without saying that you would want to go get insurance quotes. And we know that insurance is priced for a short term, and that's an Achilles heel. But when you go to get an insurance quote, they're going to ask you a lot of questions about a property. That set of questions is essentially a roadmap for adaptation, because insurers are going to want to charge more or less based on what they perceive and that their scientists have modeled as devices, features, and attributes of the property and the surrounding area that reflect adaptation or non-adaptation to the trends. So while insurance itself isn't priced for a 30 or 50-year hold cycle, the data elements that are used in price and insurance are a great signal about what actionable items there may be surrounding that property and its ability to adapt.
Okay, as we get close to the top of the hour, we will wrap things up. I do want to again thank our presenters for this fantastic content today and for presenting for the webinar. Again, just for those who got on late, I want to remind everyone that the webinar is being recorded, and a recording of the presentation will be made to registrants within the next 24 to 48 hours. Thank you, everyone, and have a great rest of your afternoon.